Welcome, students of Form 4. Once again, we're going to be addressing the topic of stock control. In today's lesson, we'll be looking at procedures of maintaining stock records. My name is Ms. Nisha Bamfield. Thank you for having me. What is stock control? Stock control is a term for any and all procedures involved in monitoring and managing the amount of stock in your business at any given time. Developing your stock control procedures involves three basic actions. 1. Determining stock level policy. 2. Implementing inventory control. And 3. Cross-checking inventory control. Stock level policy. What is an appropriate amount of excess inventory to hold? The answer is obviously different for wholesalers and retailers, for convenience stores and supermarkets, for different industries likewise. Some businesses may have widely different rules for excess stock in different departments. Example, an electronics retailer probably needs to keep far more batteries for extension leads on hand than widescreen TVs and other prestige items. This is the basis of stock level policy, and stock level policy is fundamental for inventory control. Inventory control. Inventory control combines stock level policy with projected sales or production, depending on the type of business you're running. Because these functions in the same way, they're both sometimes called projected run rate. Projected run rate gives you the expected amount of inventory needed over a given time period. Stock level policy tells you how far over that to keep your stock levels for each product. Cross-checking inventory control. Inventory management software streamlines inventory processes. It can be a huge advantage, but there are a few things it can't do. It won't catch shrinkage, inventory which has spoiled, been damaged, been lost, or stolen as it happens. Cross-checking are necessary to confirm your inventory records. These are known as stock audits. Stock control policies and procedures. Stock control is basically monitoring and managing the amount of stock either on the selling floor or in storage at any given time. It is very important that this is done efficiently because stock is the single largest asset of the store. Question: for inventory management to be effective, someone must be responsible for if you said setting appropriate policies, establishing recommended inventory levels, ensuring that control systems are functioning properly, that is correct. Here's why. Stock management is to increase the store's profit by ensuring that suitable levels of stock are in the stores at all times. The policies and procedures used to accomplish this will vary dependently on the type of the store. Let's turn our attention over to the methods of stock control. The two basic methods we will be focused on today are the FIFO, which is the first in, first out method, and the LIFO, which is the last in, first out stock record control method. The FIFO, first in, first out inventory management, seeks to sell older products first so that the business is less likely to lose money when the products expire or becomes obsolete. The LIFO, last in, first out, inventory management applies to non-perishable goods and uses current price to calculate the cost of goods sold. Inventory management is a crucial function for any product-oriented business. First in, first out, and last in, first out are two common methods of inventory valuation for businesses. The system you choose can have profound effects on your taxes, income, logistics, and profitability. Companies operating on the principle of first in, first out value inventory on the assumption that the first goods purchased for resale become the first goods sold. In some cases, this may not be true, as some companies stock both new and old items. Due to the fluctuations of the economy and the risk that the cost of producing goods will rise over time, businesses using FIFO are considered more profitable, at least on paper. Example: a grocery store purchases milk at regular intervals to stock its shelves. As customers purchase milk, the stockers push the oldest product to the front of the fridge and replace newer milk behind those cartons. The cartons of milk with the nearest expiration dates are thus the ones first sold, whereas the cartons with the later expiration dates are sold after the older ones. This process ensures that older products are sold before they perish or become obsolete, thereby avoiding loss in profit. The last in, first out method of inventory entails using current prices to calculate the cost of goods as opposed to using what was paid for the inventory already in stock. If the price of such goods has increased since the initial purchase, the cost of goods sold will be higher and thereby reduce profits and tax burdens. Non-perishable commodities like petroleum, metals, and chemicals are frequently subject to LIFO accounting. LIFO isn't a good indicator of ending inventory value because the leftover inventory might be extremely old and perhaps obsolete. This results in a valuation much lower than today's price. LIFO results in lower net income because the cost of goods sold is higher, so there is a lower taxable income. By using more recent inventory in valuation, the cost basis is higher on current income statements. This reduces cost profit and, ultimately, net income. This is the implication of LIFO, and many companies prefer LIFO because lower profit reporting means a reduced in tax burdens. FIFO and LIFO similarities and differences. Number one, FIFO and LIFO are quite different inventory management techniques. However, they are similar in one regard. Both depend on the product remaining the same, with price being the only fluctuating element. Number two, FIFO and LIFO influence a company's earnings on paper. FIFO is most successful when used in an industry in which the price of a product remains steady and the company sells its oldest products first. That is, FIFO is based on the cost of the first goods purchased, ignoring any increases or reductions in price for newer units. LIFO, in comparison, works well in an industry in which prices fluctuate and the newest units are sold first. Because FIFO results in a higher net income during periods of rising prices, it also results in higher income tax expenses. Conversely, if LIFO method is used during a period of rising prices, it will result in lower net income. Hence, this method would result in a lower income tax expense. Another main difference is that FIFO can be utilized for internationally based financial statements, whereas LIFO cannot. Finally, FIFO and LIFO allow businesses to calculate the cost of goods sold differently. From a tax perspective, FIFO is more advantageous for businesses with steady product prices, while LIFO is better for businesses with rising product prices. Let us look at LIFO versus FIFO. On the note of cost of goods sold, LIFO is higher. On the note of income before tax, LIFO is lower. Income tax, LIFO is lower. Net income, LIFO is lower. Cash flow, LIFO is higher. And inventory balances, LIFO is lower. On the other hand, FIFO is lower for cost of goods sold. On income before taxes, it is higher. On income taxes, it is higher. On net income, it is higher. On cash flow, it is higher. On inventory balance, it is also higher. We have come to the end of today's lesson. Let us turn our attention to the exercise to be completed in your notebooks. Number 1. In your own words, define and explain what is vendor managed inventory, also known as VMI. Identify 4 ways a business can avoid over or underspending on stock. Number 3, list and explain 3 advantages of stock control. And 4, identify 2 additional ways to use stock requisition forms to maintain stock records. My name is Ms. Nisha Bamfield, and thank you for having me for today's lesson.